But at least, Steve, we're out of that 18-month consolidation of gold. In your opinion, is that a legit move or is it a head fake?
No, I do think it's legitimate. However, nothing goes straight up. So anyone who even looks at charts, there's been a just very obvious consolidation triangle pattern that's formed over the last, call it 7-8 months. I don't have the charts in front of me. But we got a clear breakout from that last week. And then once that happened, the next thing you're looking at from a technical perspective is for a higher high. And that previous high was 1880. So not only did we break out from that triangle pattern, but we made a higher high and we closed the week there. So that's very encouraging. However, nothing goes straight up. So from a technical perspective, it would be, I think, healthy to see, a back test of 1880 or even the 200-day moving average. I'm not sure we'll get all the way back there. That's down just a little bit above 1800. But I do think the trend has changed. That's what I'm seeing on the charts. That's what the fundamentals suggest. So what I'm looking for is higher highs and higher lows going forward. But, from a strategic perspective, let's buy dips. Let's not chase rallies if you're looking to accumulate, especially the volatile mining shares.
Hey everybody, this is Rob Keynes from GoldSilverPros.com. I'm here with a very special returning guest. It is Steve from the Silver Chartist. Steve, how are you doing today?
Good, Rob. Thanks for inviting me back. It's always fun to speak with you and connect with your audience, so thanks for inviting me.
Yeah, absolutely. I think we first talked maybe last year. It was after our conference in August, and we had you on in a roundtable and had a great experience. Been following a lot of what you write in your newsletter for quite a while, and you do very, very well with the charting and helping people understand where the market is. Before we get into that piece of it, I did want to talk about where we were in gold. Last week, we hit 1900 for the third time by my count. Basically, in human history, I think is a very positive sign for the precious metals. Silver, of course, is not broken out. It's still in that $22 to $24 range that we've been sitting at for a long time. But at least, Steve, we're out of that 18-month consolidation of gold. In your opinion, is that a legit move or is it a head fake?
No, I do think it's legitimate. However, nothing goes straight up. So anyone who even looks at charts, there's been a just very obvious consolidation triangle pattern that's formed over the last, call it 7-8 months. I don't have the charts in front of me. But we got a clear breakout from that last week. And then once that happened, the next thing you're looking at from a technical perspective is for a higher high. And that previous high was 1880. So not only did we break out from that triangle pattern, but we made a higher high and we closed the week there. So that's very encouraging. However, nothing goes straight up. So from a technical perspective, it would be, I think, healthy to see, a back test of 1880 or even the 200-day moving average. I'm not sure we'll get all the way back there. That's down just a little bit above 1800. But I do think the trend has changed. That's what I'm seeing on the charts. That's what the fundamentals suggest. So what I'm looking for is higher highs and higher lows going forward. But, from a strategic perspective, let's buy dips. Let's not chase rallies if you're looking to accumulate, especially the volatile mining shares.
I agree with you. And silver hasn't broken out yet. It had a nice little move that kind of mirrored gold, but much more muted fashion. The mining stocks as well have popped a little bit, but not really. I haven't gotten back to where they were even a year or two ago. Are those going to follow gold? Does gold need to hit 2000 again, or what is your view on that?
Yeah, so if you go back and look, and I know you're familiar with this, but typically what happens in a precious metals breakout is gold leads, then the senior gold miners lead, those institutions who take note of the sector. So we're seeing that, GDX, we're seeing the Barracks, the Newmonts, the Franco-Nevadas leading. And then what happens is the more speculative subsectors of the precious metals sector follow suit, and that includes silver and the junior silver miners. So it would be logical to expect them to follow suit and play rapid catch-up. So I do expect that at some point.
So you do a lot of charting at Silver Chartist. Also describe for people what else that you do. What value do you bring if they're interested maybe in getting to know more about your services?
Sure. So I started on Twitter, and I was a little bit frustrated in that I wanted a larger. I want to be able to share more content, and Twitter limits your thing. So we started doing just a free weekly newsletter. And the idea is there just to provide a ton of value for free. And we did end up offering a low ticket premium service, but the idea is to give a over-the-shoulder service of exactly what I'm doing. And we focus a lot on the macro, but also on strategy. A lot of new people to this sector say, hey, I'm going to go all in on gold and silver, but they don't necessarily have a personalized strategy. So I like to think we help people craft that and, get more out of this coming bull market.
It's interesting that you mentioned that. A lot of people do talk macro. We like to talk strategy as well. In fact, our conference coming up in April, which you'll be at, is going to be for investor strategy specifically. Can you give any hints or insight as to what your personal strategy is right now with this market?
Sure. So I think there's three kind of broad strategies. You can dollar cost average, you can accumulate on weakness, or you can buy breakouts. Some people do that. So I do a little bit of all three. When it comes to physical metal, I just dollar cost average every month. I don't care what the price is. I'm just exchanging paper fiat for real money. I don't care what the price is. When I accumulate mining shares, I scale in on weakness. So I love those sharp pullbacks to scale in on weakness, especially to key technical levels. So that's where the charting comes in. So with the mining shares, that's how I do that. And then when I trade, I take about 10% of my overall portfolio and I swing trade it. Now, that's not for everyone. I think a simple buy and hold strategy over the long term is more suitable for most people, and it will outperform. However, for that monthly cash flow, I take 10% and I trade. And when I do that, I'm looking for breakouts, and I like to trade with the trend. So those are the three strategies I use.
And talking about the mining stocks, it's a little bit different than the metals. How complicated are those to learn to trade? You gave one suggestion on scaling in, weakness or temporary pullbacks. How much work does it really take you to analyze some of these stocks and come up with a strategy, and which ones that you want to be in?
Yeah, so true. The mining sector is not like analyzing normal stocks where you look at PE ratios and cash flows and all that. It's a whole different ball game. And to be honest, that's not my sweet spot. I don't specialize in drill results and all these things. So what we've done is I've surrounded myself with people who are experts in those things. People like Jeff Clark, 𝙂𝙊𝙇𝙀𝙍 is someone I like to look up to. So once I like to say fundamentals tell me what to buy, technicals tell me when to buy. So I kind of rely on other people to tell me what are the best mining stocks right now, as far as fundamentals, drill results, all those kind of things. And then I put them on a watch list, and then when they hit key technical levels, that's my buy signal.
Yeah, that's a good piece of advice. Your portfolio, does it have a lot of these stocks, or do you limit yourself to like top 10 or something along those lines?
I don't like to have more than 30. Right now I have 20 precious metals mining stocks, and even that's a lot because, like Rick Rule likes to say, especially in the explorers and developers, you should have about an hour a month to develop, to set aside to follow these individual stocks. And that can be pretty burdensome. So I divide my portfolio into royalty and streaming companies, senior producers, junior producers, and then the explorers and developers. And for me, I put about 20 to 25% of the total portfolio into these explorers and developers because they're much more risky and they require more work to keep up with. And I think that's a common mistake, maybe for some people who are new to the sector, is just going all in on the explorers and developers. I think that's totally fine as long as you know what you're doing. If you're prepared for, some of these things are down 70, 80% from their peaks. If you're prepared for that and you have a strategy, that's fine. But if you don't know, you see a lot of new people do that, and then they sell at the worst time. So 20 to 25% is right for me, personally.
Yeah, that's true, and that's what I like to do. And I never, even when I wrote a mining stock newsletter, never liked to cover more than 30 or so because I believe that the lessons you learn in those 30 you can apply to other stocks. So you don't have to cover them all, certainly about 1,000 or so in the space. Really what you need to do is pick the ones that you're interested in, understand how to analyze those, and apply the same principles that you would any other. And I like the fact that you limit the portfolio down. I find a lot of people have 60 or 70 that I've consulted with. They've come to me and said, hey, can you take a look at this? And the first thing I do is I look at the number they have, and I'm like, wow, how do you follow all of this? And unless you're really doing this full time, it's very difficult to follow that many companies.
Yeah.
So you use a service like Jeff Clark or 𝙂𝙊𝙇𝙀𝙍, and I've talked to them before. They spend an inordinate amount of time looking at these mining stocks, going on tours like I did in Guanajuato last week. It's a lot of work. If somebody doesn't have all that time, does it make more sense just to sign up for a service like yours or Jeff Clark's to basically get that information? And if so, follow-up question, how much of their own research should they do there?
Well, what I've personally done is I subscribe to a couple of newsletters, and Jeff Clark is I'm grateful and privileged to have him as a contributor to the Silver Chartist. So, yeah, that's how I get my education, is subscribing to good newsletters. And I'd prefer to pay for education because, I'm always I'd rather pay and get quality and have people I can trust. So Jeff Clark is one of the best, in my opinion. Another random thought I had is, as we're talking about the mining stocks, is a lot of new people tend to kind of get really emotionally attached to their mining stocks, almost like a sports team, And, I would say that's another pitfall to avoid. If the story changes, you got to cut those things loose and not be emotionally tied to them. Don't be afraid to push the sell button when the time comes.
That's right. And the story can change very easily. I mean, you can have a project which looks feasible. For example, the project Guanajuato Silver has, and just mentioned them since I was on the mine tour last week, was originally bought by Endeavor for $200 million. And once they got into it, they didn't. I think the story that we're figuring out is they didn't have the resources really to circle around this project. It was one of many for them, and they needed a dedicated team. Well, Income's 𝙂𝙊𝙇𝙑𝙀𝙀 Silver. They pay $15 million, but that team is on that project only and developing that project. And I think that's what really matters. A lot of times you see companies, and all you do is look at their PowerPoint, you look at their assets. It looks good. But what you don't see is all the work that goes into really running these projects. And if companies get too broad, sometimes that can be a detriment to them. And I think that's why sometimes it's better to have some of these smaller companies develop that project, because they're focusing on that. And that's why you see 800 to 1,000 of these. It's very difficult for one or two companies really to sort of dominate this space. And it's a lot different, I think, Steve, than in the tech sector, for example.
Yeah, 100%. Yeah, like Reyna Silver is another example that comes to mind. That was previously owned by MAG, but great deposit, great potential there, but they just didn't have the resources. So they spun it off, and now it's a team that can focus just on that one project. I think now they've got two or three, but that was the intent.
Yeah. Getting back to the macro for a moment, we've had a lot of news lately, and this is all I've been talking. I talked to several people last week about it, just talked to Jason Kozins, the CEO of Glint, this morning. So I've been talking macro, I think, for 2 weeks straight. A lot of drivers there. Of course, we know about inflation. It's been high for probably 6 months, 7 months. We have the geopolitical concerns with Taiwan and Ukraine. What to you really stands out from the macro perspective in terms of what's driving this interest back to gold as a precious metal?
Yeah, I think the geopolitical uncertainty is certainly a part of it. However, I don't think that's the main driver, even though that gets more of the headlines, because the move had started before this Ukraine headlines really started heating up. And, when patterns repeat, people start to take notice earlier. And in the previous rate hike cycles, the last one being 2015, what happens is the metals sell off ahead of time. And then when we get that first rate hike, it becomes a sell the rumor by the news event. And I think the market may be anticipating that right now, because everyone and their brother who's looked at previous rate hike cycles knows that what tends to happen is the metals rise afterwards. Well, maybe that's shifting to the left as far as time goes, and we're seeing that in advance. So I think that's one possibility. As far as the geopolitical stuff, it always makes me nervous a little bit when metals rise on geopolitical concerns, because they can come back down just as fast. That's often what happens. So that's kind of where I think we're at right now. I'm looking for either silver to play rapid catch-up or for gold to have a little bit of a pullback, but higher highs and higher lows is the baseline expectation.
Yeah, I do think that the big players are front-running some of the precious metals with the rate hikes, because we saw on the COT report from the CFTC, which looks at the commitment of traders or the trader positioning on the derivative markets and the COMEX. And they had gone net long in silver a couple of weeks ago, then came back net short, but only a little bit. Instead of being massively net short, the bullion banks went about even the last 3 to 4 weeks. And that's pretty much unprecedented. I haven't really seen that happen very often in the last 12 years since I've been following, since the last crash. They've been net short. And the reason the bullion banks go net short, they're the ones that are basically on the right side of the trade, right? So when the prices aren't going up, they go net short, make their money that way. When they flip to net long, like they did in silver, that's usually a pretty big indicator. They expect the market to go long, and they don't want to be caught too short. Now, gold, they're still a little bit short, but they're alleviating that position. So it seems to me the smart money on the derivative markets is moving along the precious metals. And again, maybe they are front-running that rate hike news a little bit. And maybe they're trying to take advantage of some of the news cycle as well. But it does seem as though some of the smart money really is aligning that way. What are your thoughts on, do you think this move is sustainable? I know that we have the economic fundamental argument behind high inflation and potentially the Fed raising rates. Let's say the Fed gets to 1% this year. If Bullard gets his wish from the St. Louis Fed, they get to 1% by June. Do you think that move up in the interest rate substantially impacts the precious metals prices? Would you expect to see on a chart, it really to start to get really bullish?
It's going to be really interesting to see how this resolves, because I still think there's a lot of general market participants who think, well, the Fed's going to raise rates nominally and they're going to maybe crush inflation. I mean, I think you and I know that's not going to happen. Even if the truth is somewhere in the middle, which I don't think is likely, they get interest. Let's say they get inflation down from 7.5%, and then they get interest rates up to 3%. That's still negative interest rates, which is the primary driver for precious metals. So that major fundamental tailwind is still going to be there. How it reacts in the short term, we're going to see volatility in both directions based on headlines and everything. But, I do think the trend is up. And by the way, what's happening in Canada, too, is just another catalyst for the metals. If you're in Canada, who wants to keep your money in a bank? If you're smart and you've got a large amount of money, gold makes a lot of sense right now.
That's a really good thing to talk about, because with the the equivalent of executive orders, I don't know what they are in Canada, but Trudeau basically, threatening people and, threatening banks who maybe have supported, that it's very interesting to, whenever a government really wants to clamp down on the banking system, they can. And if you've got all your eggs in that basket, you could be trouble. You could think you're very liquid and have a cash position, but you could be in trouble. And then we're not even talking about the potential default risk of banks, Steve. I know that there's a ton of debt out there. Banks have a ton of it. The corporates have a ton of it. At some point, this is going to come home to roost. And we haven't been talking about this for a while because of interest rates and the geopolitical. What about that debt situation that's out there? I mean, are we going to have a black swan? Are we going to have a Deutsche Bank finally go under, after all of this debt creation that we've had in the corporate and the banking sector?
Yeah, I think, the people who are in the precious metals community, we know this. We probably started out looking at this super zoomed out view, but then we can get in the weeds all the time. And I think it's important to remember, especially when you see the gut-wrenching pullbacks, that the U.S. government and governments all around the world are in a predicament where there is no solution. There is no solution to this problem. With the U.S. having a $30 trillion national debt, it is mathematically impossible to repay. And they have two choices. Those two choices are they can default honestly or inflate away the debt. And history suggests 100% of the time they're going to choose to debase the currency. That's just what happens. So it can be gut-wrenching in the meantime, but if you keep that in view, there's no solution to this problem, and precious metals are going to be the prime beneficiary as all of this eventually resolves. So, it's going to be crazy over the next few years. It's going to be volatile in both directions.
I agree with you. Yeah, I totally agree with you. I was speaking with Jason Kozin, CEO of Glint, this morning. He's like, basically, you want to start your gold savings account. That's essentially what you want to do. It's wealth preservation. I think it'll be more than that if we have a big bond default and currency trouble. I think gold and silver will go up more. They're not just going to track, pent-up inflation. I think they're going to spike, and it may even get into a bubble. And that'll be the interesting thing, too, Stephen. We come back maybe a year or two from now and come back and look at this, and we're talking about how to get out of your metals. Because at some point, they'll be really high. They'll have tremendous value. You want to get out of them before they come back down to earth. Do you see that potentially happening as well? Should there be an exit strategy for people to get into precious metals?
100%. I think, I like to say, whenever you push the buy button, have a subsequent plan to push the sell button. For me personally, I've got a certain amount of physical metal that I just plan to leave to my children, and hopefully they leave to their children's children, and it's an insurance policy for generations. But I don't want to keep all of it for that, because I've got a sizable amount in there. I've been accumulating for years. So, yeah, I do have an exit strategy, and for me, it's based on ratios, because I think the dollar is going to become an increasingly less reliable unit of account. So, I'm looking at gold versus real estate, gold versus stocks. I look forward to a day. I'm not sure we'll get there, but I would love the day when I can trade some of my metal and just buy some dividend-paying stocks and not be looking at this stuff all the time and just go live my life. That's part of my exit strategy. So
is your exit strategy, will you talk about it in your newsletter for people, who are interested? When you get to the point you're like, what, metals are frothy here? Yep. Looking at the charts, I think it's time to get out. Is that going to be some of the advice that you give?
Oh, yeah, 100%. Every time I push the buy or sell button in a long-term account, I send an alert out, and I explain why. But my exit strategy, rather than get into the details, for me personally, the plan is to de-risk the portfolio as the bull market matures. So take profits from the junior explorers and developers, maybe cycle them into the Franco-Nevadas, the senior, relatively safer plays. And then you can maybe consider swapping some silver for gold, some platinum for gold. So you still have exposure to the sector, but you're de-risking, locking in kind of those profits as the bull market keeps going. And eventually swap some of the mining stocks for undervalued things that are right now in bubble territory. Those things will eventually be, down in bargain basement prices.
Yeah, they will be. And a good point that you made there, swap into quality, because the bigger companies, the Barricks and Newmonts of the world, tend to do, better over the long run after we get through these bubble cycles. They tend to hold their value. Not that the developers and the junior explorers are bad, but they just tend to fluctuate a little bit more. It's kind of like silver to gold, right? Silver fluctuates a little bit more, so you have to be a little bit more careful with your strategy there.
Yeah, exactly.
So one of the reasons we brought you on is also to help out our listeners, because we used to have like a charting service and a stock service. We don't do that anymore just because it takes so much time. And there's so many people out there that have developed that way ahead of us. And what we like to do is focus on research, education, putting the truth out. So that's what we're focusing on. But we're kind of teaming up with you, Steve, in order to offer our viewers, a solution if they're interested in getting involved with your service. It's excellent. I get it every week. You do wonderful videos and content. So I think that's the way to go. Just point our listeners to the expert. So why don't you talk a little bit about how people can get involved if they're interested in finding out more about your service?
Sure. I'm sure you'll put a link below this video, and that's a unique link just for your listeners. And then I'll take you to an opt-in page just to get our free weekly newsletter. And the idea there is to provide a ton of value for free. We don't spam you or hit you with high-pressure sales tactics or anything. And if you enjoy that free newsletter, there is the option to upgrade to a low-ticket premium service. Right now, I think it's like $10 a month or something like that. It's super cheap, and that's where you get the real-time alerts. Mastermind calls, a whole bunch of other things. But every time I push the buy or sell button, it's an over-the-shoulder look at exactly what I'm doing. And I've got the counsel of Jeff Clark, and David Brady is another one of our contributors. So a ton of value, very low ticket, and I encourage people to check it out. And if you don't like it, you can always unsubscribe.
When I went to 𝙂𝙊𝙇𝘍, I got a couple of recommendations for your service, and people even thought, with the amount of effort that Steve puts into this and how much quality it is, they think you're underpriced, Steve. So I just have to tell you that. So other professional newsletter writers subscribe to your stuff and think you should charge more. And I can't think of a better endorsement for anyone than that when I meet people randomly and they're like, you know what, I love his service and he needs to up his price, because the amount and the quality of information you have in there is very good. So it was David 𝙁𝙁 and Paul Harris who have been doing this for a very, very long time, fully respect your work, and said, Steve needs to charge more for his work. So if you guys are interested, you better get in there before Steve raises his prices, because it's about as cheap as you're going to get.
One of the most humbling things when we were out at the Silver Symposium, the first time I met you in person, I met David Morgan for the first time. I'm like, well, this is cool. I've been following you for years. And him and David Smith were like, oh, yeah, we subscribed to your letter. And I was just humbled. And they said the same thing. So that just, I'm humbled to hear those kind of things. Thank you.
Well, Steve, when you put out quality work like you do, and again, I've been completely impressed. It basically caused me to say, you know what, why am I doing this? I'm just going to refer people over to Steve. I don't know if I can duplicate it. So I fully have my endorsement as well. So appreciate you coming on, Steve. For those of you following the channel, we value Steve's insights so much, we're going to bring him back on a regular basis. So he'll be on the channel on a regular basis. And if you have questions for him, save those up. We'll have him on every couple of weeks. And email me at robert@𝙁𝙍𝙀, or just leave them in the comments, and we'll make sure that we get those questions asked for Steve. Steve, thank you so much for joining us. We appreciate your time today.
You bet. Thanks, Rob. Appreciate it.
All right. And exciting news coming to the channel, guys. Stay tuned. We got a lot of content out this week. A ton of guests are going to be on this week, and we're amping up the content as we get into what I think is going to be a somewhat turbulent spring season heading to the summer. I think we're going to see a lot of things. So we're going to have a lot of people on talking about that and preparing you. Remember, in April, we come back to our virtual conferences, and this one is going to feature Steve as well as some other guests, and we're going to talk about investment strategies. We're really going to get in the weeds and how investors should be managing their money through what we think are going to be pretty turbulent times. Stay tuned to the channel for more information. Hey, everybody, this is Robert. Thank you so much for watching that video content. I have a couple of quick announcements I'd like to share with you as we head out of this video. Also wanted to remind you, you can find us on goldsilverpros.com. We have a free newsletter. If you click here and enter your email address, we'll send that out every Monday to you, as well as we have special precious metals deals with leading bullion dealers here in the United States. If you click that button, you can go here and click on either Miles Franklin or ARC Silver and get the best deals in the business. Once again, thank you guys so much for joining us on the channel. Until next time, this has been Gold Silver Pros.